Hello, I'm Andrea Booth and welcome to Kaplan Professional's monthly economic update. Today I'm talking with the Chief Economist of RBC Capital Markets, Su-Lin Ong. Thank you for joining me today.
It's a pleasure. Thanks for having me.
Australia is entering its 27th year without a recession, and the government recently announced that the economy had grown by 3.4% from the year earlier. What do you think lies ahead for the Australian economy?
There's no doubt the economy has performed really well in the first half of 2018, growth running at an above trend pace. And I think for us where the surprise has been, the upside surprise has been in the resilience of household consumption as well as the residential construction cycle, which appears to have a fair degree of longevity. That's been quite key factors in terms of stronger growth. Looking ahead, we're not so sure those two components of growth will be as resilient and strong as they have been in the first half of this year. We know from the leading indicators of construction that residential construction, while there is considerable pipeline activity going on, that it will become increasingly less and less, and ultimately we expect that to detract from activity, probably more so in 2019. That slowdown in residential construction, the weakening in house prices, we think is an added cyclical headwind for consumption as we go forward. So the consumer, we think, faces a number of structural headwinds already. We know household debt is high, we know wages growth is pretty tepid, we know there's a squeeze going on in disposable income. When you add to that the slowing in the housing market, it's hard to see how the consumer can continue to be as strong as it has over the last few quarters. So we're a little bit more cautious going forward. Having said that, we know there are bright spots in the Australian economy. We know the net export side, and particularly as LNG comes on stream, is encouraging. We know that public spending, particularly at the state level with CapEx, is extremely strong. And so there are a number of bright spots, and private business investment looks a little firmer too. So overall growth for the current year we think will be 3.25%, maybe easing a little next year to around 3%, but that's a decent pace of growth and above trend. So it's an economy that's in reasonable shape, notwithstanding, I think, some of the challenges for the dwelling sector and for household consumption.
The former Treasurer, Scott Morrison, is now our Prime Minister, and Josh Frydenberg is now Treasurer. What are your expectations for the economy with these two at the helm?
Look, I think it's very early days at the moment. The new Prime Minister has barely been there a few weeks. The very early signs, I think, are encouraging. We know that there's a few policies that they're looking at that we're hopeful are supportive of the economy, both near and medium term. The discussion around the bringing forward of company tax cuts for small businesses and accelerating that, I think, is a positive. We know small business is the bulk of businesses and key in terms of employment, so that's a good sign. Discussion around a drought package is important as well. Farm GDP is about 2.5% of overall GDP, and big swings can have an impact on the economy. So, the drought continues to be a significant factor. Assistance on that front will help temper the impact on overall activity. So that's reasonably encouraging as well. So there's a few, I think, policies that look interesting and are supportive. I think importantly as well, we know that the new Prime Minister, formerly in his Treasurer capacity, was very committed to returning the budget to surplus by 1920. The revenue looks like it's running ahead of forecasts. I think there's a good chance we will see at the mid-year update in December that story continue, and a surplus is well within target over the next 12 to 18 months, and I think that will remain a feature of the Morrison government, so that is encouraging as well. It's not all roses though, I suspect. I think medium term, there will need to be some discussion over real reform, whether that's labour market reform or tax reform. And I think really the big uncertainty obviously is around energy policy. The NEG is probably not going to get up in its current form. There continues to be a great deal of uncertainty over energy policy, and if you speak to businesses, that remains their key concern. So there are still a number of challenges, but it's early days so far. What we've seen is reasonably encouraging.
On to international matters now. The media keeps reporting about the threat of a trade war between the US and China. How real do you think this risk really is?
I think that you wouldn't want to underestimate the possibility of an all-out trade war, and we've already seen steps towards that. The current tariffs that are in place between China and the US are fairly modest, around 50 billion, but there are threats of substantially more, and the US is now suggesting really the dollar terms that they're talking about is pretty much tariffs on all of the exports from China that come into the US. So that's not insignificant. You know, it's a little under 500 bill. That's a different story. It's tenfold what it is now. Now, will we get to that? Well, it's entirely possible, but the odds are we're going to get part way towards that, and that has enough implications on its own. So from that perspective, I think we are all pretty wary here. I think what's interesting is that it's partly, I think, factored into markets' expectations that maybe global growth, not so much this year, but as we look forward into 2019, will be weaker. There's a sense in markets that maybe this is as good as it gets for global activity right about now. So, you know, it is pretty strong. We're probably going to record close to 4% growth for the globe this year. The odds are it's not going to be quite as strong next year. And so I think it has a number of ramifications for both activity, definitely for business confidence. You know, what does that then imply for hiring and expenditure? So it's not something we take lightly. And I think what is also interesting in all of this is, you know, trade wars are not new. We've had this on, you know, many times over the years. What is new this time is we have a president in the United States who operates in quite an unorthodox way, both from his means of communication to his policy announcements, and that I think makes it, you know, somewhat more difficult than in the past.
Australia's economy is heavily reliant on China. It is our largest trading partner. Is it too risky to remain this way, and how could we move away from this reliance?
I don't think it's a question of too risky. At the end of the day, you know, China is, you know, either, depending on what measure you use, the second to third largest economy in the world. It's moderating in terms it's gone from double-digit growth down to 6-7% growth, but it's coming off a much larger base. It is a big, important economy, and more importantly, it's going from, you know, developed nation to much more fully developed, and that has implications, I think, for growth more broadly. And so it's not a question of risky. Australia, at the end of the day, has a comparative and a very strong comparative advantage in commodities, particularly the bulks. And, you know, China takes half of Australia's iron ore, and so that's where the strength of the relationship is. I don't think we would ever want to try and shift that relationship, given our comparative advantage, given that it goes to you know, a very large economy and a nation that's developing. So I think it's an incredibly important trading partner and export destination. Do we need to try and diversify a little bit? Should there be other measures in place? Well, I think we only need to look at, you know, what Australia's done in terms of key service sector export, tourism and education. You know, they are growth industries. China is very significant in both of those. It has important knock-on effects to the broader economy when tourists come here, when students come here, in terms of dwelling, in terms of consumption. And so I think to some degree we are doing that already. And the other important part of that story is LNG. So, you know, the big story in Australian exports last year, this year and into next year is really the growth in LNG exports. And so this is the third phase of what was a massive investment cycle to production and now exports. And that is not targeted at China. Most of those LNG exports at this stage are going to South Korea and Japan. So there is a little bit of diversification, I think, going on there, and what looks to be a structural shift in Australian exports, with LNG increasingly important.
Moving on to foreign exchange now. How are the emerging markets impacting upon the Australian dollar?
So this is an interesting question. We always get asked, you know, who cares about the Turkish lira? Like, why, you know, are movements in Turkey so important for the Aussie dollar? And look, I think there's a couple of transmission mechanisms. The first is when emerging markets come under pressure, it prompts a very risk-off immediate reaction that sees very much a shift into safe haven assets, primarily US Treasuries, the Swiss franc, yen, gold. It's a pretty standard reaction. The Aussie dollar is quite often seen as a bit of a proxy for risk off, and so it quite often gets hit fairly hard. And it's not really just the Aussie-US cross, it's actually the Aussie-yen cross that probably moves the most, and that's very consistent with risk sentiment. So that's how it translates through to the Aussie dollar. I think the second is really, as I was saying, global growth is pretty good at the moment, and it's broad-based. I think when there's concerns over EM and concerns that volatility will ultimately be negative for emerging market growth and the impacts on more broadly on global growth, then Aussie as a traditional barometer of global growth also gets hit. And so that translates through to a weaker Aussie dollar as well. And I think thirdly, at times the Aussie dollar and Australia is perceived as having a bit, half a foot in the emerging and developed world. So it's obviously, a developed economy, G10 space, and has all the characteristics of a developed economy, but its strongest trading relationship is to China. And so at times the Aussie dollar can get hit a little bit on that strength of that relationship, particularly if any of the EM wobbles are related to China. So it's no coincidence here. Emerging market, the complex has been under pressure on and off all of 2018. That largely reflects rising yields and a stronger US dollar. The Aussie dollar, up until several months ago, was proving remarkably resilient. It only really came under pressure, really, as the Chinese data started to slow quite significantly around Q2 and middle of the year, and the Chinese authorities started to take some action. So easing rates, removing some of their curbs on lending, quite stimulatory fiscal policy, and so China looked like it was slowing quite a lot more than anyone anticipated. No coincidence. That's when the Aussie dollar started this leg lower, and it's struggling to hold 71 cents at the moment.
Thanks again for your time.
Pleasure.